I'm Dan Carell, CEO of the Digital Commerce Alliance, and this is Commerce Code, a bi-weekly digital commerce podcast for leaders in card linking, loyalty and digital marketing, mobile wallets and payments, and financial data. Thanks for joining this running conversation with leaders in the industry. And if you like this podcast, come join us at a Digital Commerce Alliance event. You can learn more at www.digcomall.org. This week, I'm talking with Jeff Richardson, Senior Vice President and Head of Marketing at VantageScore and host of the Score podcast, a source for credit score-related news and analysis. VantageScore's mission is to innovate to deliver more predictive, innovative, and inclusive credit score models for the U.S. market. Today, Jeff and I are talking about the most recent VantageScore market adoption study and what it tells us about the state of credit risk, lenders' attitudes towards 2024 as we come out of a bit of a rough year in 2023, and innovations that are changing the market for consumer credit and credit analysis going forward. Stay tuned for Taking the Temperature of the Market for Consumer Credit, a conversation with Jeff Richardson of VantageScore. This episode of Commerce Code is brought to you by Augeo, a global leader in engagement platform technologies that create compelling experiences, foster people connections, and cultivate brand advocates worldwide. With more than 45 years of experience, Augeo empowers Fortune 500 companies to deliver extraordinary brand experiences for employees, consumers, channel partners, subscribers, and members. Fueled by a holistic engagement ecosystem across workplace engagement, experiential, social activation, customer loyalty, and digital asset experiences, Augeo's mission is inspiring people to achieve more, one interaction, transaction, and experience at a time. Augeo, engagement unleashed. Jeff, thank you so much for joining us on Commerce Code. Where does today find you?
Well, hi, Dan. Today I'm in Washington, D.C., where, of course, VantageScore has many stakeholders, including DCA, but I'm at a hotel room in the Wharf, and it's a beautiful spring day here in the nation's capital.
Oh, good. As we're recording this, it's the very end of April, and I always forget when the cherry blossoms come out precisely, because it is a bit of a precise thing, but I'm hoping that you have not only a nice day, but maybe some good things if you're down by the Wharf. You're not too far away from some of those cherry trees.
Well, the cherry trees and the allergies are out.
Okay, good. We have confirmation. Yeah. Well, look, Jeff, excited to talk to you today about the most recent release of the VantageScore market adoption study, and both the thing itself, but the bigger picture and sort of what it tells us about the marketplace. And so I think probably the best place for us to start, though, for the listeners and for me, is for you to just give us the reminder, the quick background on what does that study measure? What does it sort of tell us? Because I know it's an important thing for you every year to see what it says.
The market adoption study is an annual assessment of the extent to which VantageScore credit scores are used in the marketplace. And it's, I think, part of a series of various studies that we do throughout the year that kind of all levels up to our promise of transparency to the marketplace. But more specifically to the market adoption study, we work with a third party, Charles River Associates, which is one of the most respected management consultancies in the world, who gathers data from the national consumer credit reporting companies, Equifax, Experian, and TransUnion. And they provide a data set that shows how much our scores were used. And the data allows Charles River to compare the volume of scores years year over year. We've been doing this for a number of years now, so we can do apples to apples comparisons and see growth and where the trends are leading. But they can also break it down into different categories, including non-financials, financials, loan types, et cetera. So it's a really useful report that I think reflects how lenders are and other market participants are using credit scores and shifting away from the status quo.
Yeah, and just to further to the point about the status quo, I mean, it's also a reflection of kind of the fundamental thing that's going on in the credit scoring world, which is default. Without the presence of VantageScore, there essentially would be one player, and there hasn't been a ton of change in that marketplace. Again, without you guys getting involved, there hasn't been a ton of change
in the marketplace in terms of how it works. I was just reading an article in the New York Times yesterday about, kind of how the world is evolving with buy now, pay later, for example, but the credit scoring world not necessarily as much. And so I think the point, to some extent, of, what's the usage of VantageScore and like where does VantageScore sit is at a bigger picture level, at a social and policy level. And policy, if you're sitting there in Washington, D.C., is how much is the credit scoring world evolving to try and account for the complexity and the rapid change of society, the marketplace itself, et cetera, right? So that to me, that's just my commentary and not your words, but to kind of put it in context as to why does the broader audience care about what's going on here? It's, how much are we injecting a sort of a competition, agility, flexibility, et cetera, into the way that we think about credit and credit scoring is kind of how I would think about the thing. And so I don't know if you have any further comments, I guess, on that one, Jeff, but I mean, to me, that's the why do we care big picture thing is, look, it matters to society, that we have a competitive market and a flexible and agile market for credit scoring. Yeah.
Well, so VantageScore is a mission-driven company, and that mission is to leverage innovation to drive predictive lift and more inclusive credit scores that's going to enable more access to credit for creditworthy individuals and the ability to lift up those that have largely been ignored. And the greater adoption of VantageScore reflects, I think, the marketplace's desire to move forward and embrace technology, embrace innovation, embrace financial inclusion. And, that doesn't happen in a vacuum. You need regulatory support. You need support from capital markets. And so we're seeing just a tremendous shift towards kind of what we call, maybe it's a cliche, but a new normal.
Yeah, finance is an area that to me is remarkably innovative when it's innovative. And I think most people would be quite surprised, people who are not involved in it would be quite surprised at how static it can be when it's static, right? And so your point about, it doesn't happen in a vacuum, like somebody needs to actually take the initiative to do this stuff. It needs to have regulatory support. It needs to have, other players that are involved, et cetera. And so credit scoring is an area that I guess has a choice, right? Can either be very static or can be very innovative and dynamic. And we're in a moment, it seems to me, in the history of the market where that choice is sort of actively being dealt with. And the question is how much progress are you making in opening the thing up? The thing about the study as well is that it tells us things, and this is kind of a key part of what we wanted to talk to you about, but it tells us things not only about the basic point, like what is the market adoption of VantageScore, and maybe you can kind of give us the high levels there. But then the other thing is it tells us something about credit risk, what the world is looking like right now as we're kind of moving out of 23 at this point, end of the first quarter of 24, tells us something about credit risk as well. So I'd love to hear at the high level what sort of basic findings are, but then what do you think it tells us about credit risk, the state of credit risk, and where we're at?
So VantageScore has been growing steadily since really its inception, but it's really accelerated just in the past 3 years, where every year our growth rate and sort of overall volume rate keeps surging. So kind of in a historical context, VantageScore grew 17% in 2021, 30% in 2022. And with this study, it examined market adoption in 2023, and we grew at a rate of 42% in 2023. And so that number, that 42%, reflects 27 billion credit scores used by market participants. And if that's a B, in case that didn't come through on the podcast. So if you kind of break it down from there, we cut it maybe two different ways, through financial institution usage and non-financial. And financial institution usage grew 46% year over year to 13 billion credit scores used. And non-financial institutions, things like the government, things like websites that provide consumer education and the score to consumers, that sector grew by 39% to 14 billion scores used in 2023. So unpacking that a little bit further, within the product categories, the largest sector that saw growth was in the credit card market. And credit card lenders grew their adoption of VantageScore by 172%, which is tremendous. We also saw great adoption in the auto sector, so 34% growth there. And what I think it says about the market is continued interest in things other than the status quo, but also that the pandemic and the intense focus on making sure your kind of regulatory and reg tech house and compliance house is in order is largely in the rear view. We are in a market where, of course, inflation is high and delinquencies there's kind of a slow burn of delinquencies increasing. And that's causing banks to look at their current underwriting strategies or their custom models and re-examine them and rebuild them. And as a result, a lender will have a bake-off. They'll benchmark their current scoring models against others in the marketplace, and we're seeing VantageScore win those bake-offs and provide the type of performance that they're looking for. When you're in a market where everyone's competing for the same customers, a scoring model that's going to open up 33 million more consumers into the potential pool of applicants, and then one that's even going to give you a more predictive risk assessment of those both kind of in that newly scorable population and in the mainstream population. That's going to allow lenders to grow their portfolios, reduce delinquencies and defaults. And as a result, we're seeing lenders increasingly use VantageScore credit scores, particularly VantageScore 4.0. The market adoption study also showed that over 3,400 unique banks, lenders, and other fintechs and various institutions use VantageScore credit scores in 2023, and that includes actually the 8 of the top largest banks in the country. So we're thrilled at our own growth, particularly in 2023, where the lending environment wasn't great. Overall, consumer credit originations were actually down 8%. And to grow like we did in that environment is a testament to the team, to the leadership, and also some of those trends that I mentioned.
Yeah, I mean, a couple of thoughts on that. Every time I talk to somebody at VantageScore, it seems like they're busier than a one-legged man in a butt-kicking contest, as somebody once memorably told me. But I think the other piece too is, to me, when the market is difficult and things are changing, smart players in the market will realize that doing the same thing they've always done won't necessarily get them where they want to go. Right? If the market's changing, like, what do we need to do? And so I'm hoping that the dynamic there, in part too, is that as consumer credit originations are dropping in 23, as you mentioned, that kind of a situation is just the kind of vibration necessary to get what is ultimately a pretty conservative or a pretty staid industry to say, hey, let's think a little bit differently about how we do this stuff in order to add more precision to what is ultimately sometimes a blunt and occasionally rather dumb instrument, right, which is lending. And doing it with more intelligence, to your point, can serve communities better, but can also, serve everybody better, right? Like, there's an opportunity to not just turn the dial in one direction or another, but rather to have a dial that's just more accurate, more precise, and does something better, which of course is what you guys are trying to get done.
Yeah, and where that is most reflected is in the mortgage market. They're still using credit scores that were built before even the Great Recession. So all the growth in the market adoption of VantageScore resides outside the biggest credit market in the world, which is the U.S. mortgage market. And I think we've talked about this both on your podcast and mine, the Score podcast, shameless plug. But FHFA, which is the federal government regulator for Fannie and Freddie, is requiring the usage of VantageScore 4.0 for what we call conforming mortgages, and those are mortgages that are backed by Fannie Mae and Freddie Mac, which makes up most of the marketplace. And so even in the kind of conservative and really sort of lagging market of mortgage, they're turning to VantageScore as well. So, you can be assured that, if we were in 8 of the top 10 banks, we'll be in 10 of the top 10 because they all have mortgage businesses. And it's kind of like one of those things where the rising tide lifts all ships. We're going to see a greater adoption as a result of being required for mortgages, and expect a really robust 2024 and 2025.
Well, yeah, and you mentioned 24, and that's kind of where I wanted to go next, which is, from what you see, reading both tea leaves, but also, just kind of being in the market every day and having conversations every day with the big players in this marketplace, how optimistic do you think companies are about 2024? You mentioned, for example, consumer credit originations down in 23. Nobody who would listen to this podcast would be unaware of that, I would think, or in general. But like, how optimistic are companies in your view, or banks, lenders, FIs, about 2024?
So it's a moving target, Dan. I interviewed a number of economists on our podcast earlier this year and last year, and everybody was predicting 4, 5, 6 lowerings of the interest rates, and as a result, a robust lending market. And our president, CEO Silvio Tavares, and our team was on the record saying, "Look, we're not seeing it. We're not seeing in our data," and went on the record to say, "We don't expect any lowering of interest rates in 2024." And we continue to believe that. That said, lenders and many economists remain optimistic. They're scaling back the extent to which rates will be lowered, but certainly inflation has proven to be way more stubborn than some of these experts thought. As you know, we have a really innovative digital tool called Credit Gauge. It's a free tool for everybody to use, where you can go to VantageScore.com and look up the delinquency trends within each product and within each credit tier. You can examine what utilization rates look for credit cards, and you can see what new loan origination trends were, and you can get a really strong picture of consumer credit health. And what we're seeing is delinquencies continue to rise, and we're seeing those delinquencies particularly among middle-class Americans and Gen Zers, and we're actually seeing increased on a relative rate, on sort of an indexed level, increases in delinquencies in the prime sector. So, I think 2024 is going to be challenging, and don't forget there's an election coming up, and that always adds some uncertainty to the market, and when there's uncertainty, lenders tend to flight to quality.
I wonder, and this is a related digression, but I wonder in hindsight how economists will understand the way that they understood the last 5 years in real time. I mean, your storyline there about, look, we talked to a bunch of economists, they said this, they said that, but we said we weren't seeing it in the data. And I guess there's the empirical question of whether the conventional mainstream modal, whatever, economist was more wrong in the last 5 years than they normally are. So there's that question. But it certainly seems like it, right? And I think we were spoiled by the last, generally speaking, 20 years of relatively predictable stuff. There was a wobble in the middle there, as we all remember. But, interest rates and this kind of stuff was just, things behaved sort of the way that the models would imagine them to. And we've just been it's been the weirding of the economy since the pandemic started. One wonders, what predictive models are really any good. What you guys, and like with the credit gauge thing, for example, to me, it's like when the predictive models are obviously having a difficult time adapting, what you want to do is just look at data, actual, and granted, it's historical, very recent historical, but it's stuff that's already happened in the past. But that's the data that you're using, and that you're leaning on when you say, hey, like, we're looking at what's actually going on in real time in the economy, and we don't see the things that you guys say you're seeing, which I think is just really interesting.
Commerce Code is brought to you in part by VantageScore. 8 of the top 10 banks and over 3,400 leading banks and fintechs use VantageScore to predict and manage repayment risk. Learn more about the latest advances in credit scoring and how to grow your lending business by leveraging financial inclusion at VantageScore.com.
Any conjectures on, conjecture isn't really the business you're in, but conjectures on 2025? I mean, like, as you look forward, does what you see lead you to any opinions, or is that just something that you're going to hang on to and say, well, we'll see when we get there?
Well, I think that the way I would answer that is we're investing in data, analytics, and innovation that's going to drive better insights. And we think that that's going to be really, really important moving forward. And what does 2025 look like? I'm not even an armchair economist. I think it was Winston Churchill said something about that. He's waiting for an economist to have one hand, because they are always saying on the one hand this and on the other that. So I'm not going to get into a forecast of 2025. but say that having the most predictive models and understanding what's going into those models, that it's not a black box, and using data that isn't just reflective of the past will be the standard looking ahead.
Yeah, and just to spend another minute on that one, because it's funny, I've done the loop and in work that I've done in the past in research and consulting for companies, et cetera, on predictive analytics. And the idea of a leading indicator, indicators are, all data, absent supernatural phenomena, all data is historical, right? And at best, it can be current, but even that's a second ago. And so the question is, well, what kinds of historical data, because that's the only kind, can we incorporate into our models that will help us have a greater understanding of, I think what you can say is the best you can get to the future is incentives, limitations, opportunities for current market players. Like that's what it is when we're talking about the future, because we don't know if there's going to be a meteor strike in the middle of the Pacific tomorrow or whatever. And so that's the best we can get. And so it really is about incorporating both new kinds of data. And without getting into it, the opportunities to do that in the credit scoring environment are like legion, amazing, right? And which is to say that what is currently incorporated, I think a lot of people would be surprised at not how little so much, but just like how focused the data collection is in the credit scoring world historically, and which is part of what you guys are trying to change. So there's an opportunity to incorporate new kinds of data, and then there's obviously an opportunity to engage in different kinds of analysis, right? All these use different statistical tools and et cetera to try and illuminate where current players are, where they might want to go. But what are sort of the innovations that you're excited about that you think are changing the market the most, right? And I know that there's some stuff, in what is it, I think you guys run Area 52 maybe out west. Like it's like next door to the aliens, and so you don't have the alien bodies, is my understanding. But I know there's some stuff that's secret that you're working on, but or at least I've heard. It's a rumor that there's stuff that's secret that you're working on, Jeff. But what are some innovations that you can talk about that you're kind of excited about in terms of what you think will change the credit scoring market?
Yeah, it's a good question, and I think I've been hanging around VantageScore since 2007. So I've been talking about alternative data for a long time. And even those early VantageScore models, VantageScore 1, 2, and 3, and 4, all incorporate rent, utility data when that data is reported to the files. So alternative data is nothing new to VantageScore. And it's an important area. But I think the most impactful in the short run in terms of new data sources is in the area of what we call consumer permission data, particularly in the area of consumer permission bank account data. So we're piloting a new model that actually marries the traditional information that a VantageScore 4.0 credit score uses, which is the credit file information, which remains very predictive and critical to lending, with insights that our model developers have been able to glean from cash flow behavior. And so we're able to, again, kind of due to innovation and technology, really create an easy to use and sort of frictionless ability to generate credit scores that use both those types of data. And I think you can't understate the need to make these types of technologies easy for lenders to use and consumers to engage with. Otherwise, they'll sit on the shelf. I've sat through so many new bespoke models being launched by other market participants because they were just too hard to use, too complex. They cost too much. But we're seeing some really great traction with this new model. We'll be making an announcement soon, but the reality is that by doing what we've done, by merging these two data sets, we're seeing upwards of 10% predictive lift. And we're seeing just great outcomes for those with what we call thin files or those with limited credit histories, and those with damaged credit histories. We can kind of have better separation between those likely to improve their scores and those that are probably not. That's all reflected in cash flow. And we won't be the first to enter into this market, but what we do believe is we've created the best model, the most easy to use model, an FCRA compliant model and a model that, if you're already using VantageScore 4.0, doesn't require you to have a whole separate strategy, a whole separate credit underwriting policy. It can operate seamlessly within your current strategy. And so, that's a little bit of inside baseball, but it's also why some of these, status quo models remain in place, because, some of the newer ones are too difficult to implement. It's why VantageScore 4.0 has grown so much, because it can kind of be replaced seamlessly with these older models. So we'll be making that announcement here shortly. Hopefully I'll be invited back and I can share some more specifics about it. But I think that really is going to be kind of a standard way in which scoring models operate, and in some respects already is. If you go to a large institution and you're a customer of that institution, they're likely already looking at your bank account statements and cash flow and spending habits before they make a credit decision. So this automates that and allows the broader market to do it as well.
Yeah, that's great. And just to double click on the opportunity for those who aren't as deep in the market, maybe, and there'll be probably some listeners who aren't. You mentioned before in passing the rent and utilities, and the fact that VantageScore has kind of incorporated that data. I mean, if you're absent or prior to the arrival of VantageScore in credit scoring, you're a 26-year-old, you just graduated from college, you're paying, you got an apartment, you're building your credit, like that's on your mind. Your biggest single payment would be rent. Utilities would be up there. And I think maybe people just have never thought about it, or maybe they just assume that making those payments would help their credit score. And historically, the answer was no. Like there's the system has no cognition of that at all. Totally unaware that you have rent, that you paid it, that you didn't pay it, it was late, it was on time, whatever. And so there's a two-sided problem to that, right? One is you're not building your credit score at all with the biggest single payment that you make, probably on time every month. But the other thing is that you're robbing the credit market of the intelligence that relates to that, right? And so it never made any particular sense. It's just the way that it was. And so that's one of the big nuts that you guys are trying to crack from the very beginning, and have largely done it. And then, I guess I say all of that in order to say there's loads more opportunity where that came from, to simply make the dial more precise, right? To make the whole thing better. And that's some of the stuff that you were talking about here as well. So I think that's exciting. Any, I guess, last words, Jeff, as we tail off? We're looking at here we are at the end of, I guess it'll be the beginning of May. And so we've got, most of 2024 ahead of us. Any last words as to what you're looking forward to in 2024? What are you excited about? Where's this headed for you this year?
I'll close it out by sharing what I've shared with groups I've spoken to in the past, groups of lenders and those that work at the credit bureau, which is that never in my career, which again expands back to 2007 with regard to VantageScore, has the opportunity for new and innovative credit scores been so great and so ripe and so right in front of us. And it's really exciting, particularly for those of us that have been around VantageScore for a long time, to see all of the hard work and innovation and investment in transparency and digital tools resonate. It is the right time, the right place, and it's great to have momentum like this.
Terrific. Well, Jeff, thank you so much for joining us on Commerce Code, and we look forward to having you back later on this year and talk a little bit more about how things are going.
Thanks, Dan.
Commerce Code is sponsored by Pentadata, the all-in-one financial data API. Whether it is bank account data, credit card transaction data, or credit reports and credit scores, Pentadata has it all in one simple and easy-to-use API. With coverage of over 6,000 banks, over 200 million credit files, and 60 million merchants, you can get all the data you need for your apps at pentadatainc.com. Commerce Code is a bi-weekly podcast bringing you conversations with executives who are leading the way in digital commerce. If you like Commerce Code, your company should join the Digital Commerce Alliance and become part of our mission of advancing trade for good through standard setting, industry networking, conferences, and best practice sharing. Check out our website at www.digcomall.org. On behalf of DCA, have a great week.